Welcome to the Money Study Podcast with Jim Bishop. In this podcast, we bring lessons on personal finance to life, helping you achieve the dignified retirement you deserve. Jim will guide you through practical financial strategies and tips to manage your money during your working life and through retirement. Now, on to the show.
Hello and welcome to the Money Study with Jim Bishop. Jim, good morning. How are you?
Good morning, Eric. I'm great, buddy. How are you today?
I'm doing fantastic. The weather is warmer. Thank the Lord. I mean, it's been so cold. I felt like it was so cold for so long, and I want to get outside and do some things.
Man, you need to come down here to Tucson, Eric. We're not in the same location, but it's pushing 90 this weekend, I think, if the weather forecasters are right.
Yeah, I was super excited. We had a day of 77 earlier this week. Well, currently it's 29. So, whatever.
But you come on down. We'll put some steak on the grill and put a margarita in the blender and hang out in shorts in the backyard, buddy.
Yeah, that would be fantastic. All right. I know that you're diving into investment basics in a new series, correct?
Yep, that's exactly right. We're, we see a lot of folks who make a lot of mistakes in this area. Our goal in this session is really not to make you an expert investor necessarily, but give you some good framework for asking questions. And I like to say being a good consumer, understanding what questions you need to ask and how to communicate with a financial advisor and just sort of making you a good consumer.
Yeah, absolutely. So would you say that this podcast is going to be geared more for people early in their career, mid-career, late career? What's the time frame here?
I see these mistakes across the board, Eric. I mean, I see young folks who put all their money in a fixed account making 1 or 2%. And we'll talk about why that might be not the greatest strategy if you really thought it through. We see folks mid-career who picked an investment strategy when they started work and did something and have never looked at it again and changed it. And then I see people in retirement who some take too much risk, some take too little risk. Some people don't really understand it. So I really see it across all spectrums.
Yeah, I know I've made mistakes most of my years, so I can relate to that. I know.
I should add though, Eric. There's no real mistake as long as you're saving money and putting money away. That you really didn't make a mistake. So I use that term maybe incorrectly. You're doing the right thing. We might be able to do it a little more better, but I guess optimize it more. But I don't think there's any mistake as long as you're putting money away. You're not making a mistake.
All right. And you've talked about diversifying before. And I know that would be beyond, like you said, if you're saving, you're doing the right thing. But diversification is kind of like that next step of positive things, correct to do?
Yeah. And I think we could spend the whole next session on diversification and how to manage risk. Risk isn't an all or nothing proposition. We don't have to be all, Bitcoin. We also don't have to have it all buried in the backyard, in a can. So somewhere along that spectrum is probably a right solution for everyone. And we can talk about how to sort of find that in the next session.
Okay. So in this session, we're covering why taking risks makes sense, right? I mean, people don't want to be risky. They don't want to, take too much risk. But from my understanding and from discussions I've had with you and other folks, there has to be some sort of risk to have some sort of reward.
Yeah. So, this is the idea of real rate of return is an important concept to understand, right? The rate of return, the difference between the price inflation of stuff you want to buy, how fast it goes up relative to how fast your account goes up, right? So if you're sitting over here making 0.5% in a bank account, but the stuff you need to buy is going up in price at a rate of 3%, or worse yet, your healthcare costs are going up at a rate of 5 or 6%. You're really going broke slowly, right? That's a tongue twister. Say that one 3 times. Going broke slowly. Going broke slowly. But it's the truth, right? So there is this hidden risk. People understand market risk. They don't want to take too much market risk. They don't want to lose money in the market. They don't want to get hurt. I understand that. The other side is there's this go broke slowly or hidden risk where your investments don't keep pace with inflation.
Yeah.
So
it's so funny because when you said going broke slowly, which I probably can't say 3 times fast either, the first thing I pictured was the Far Side. I don't know if you are a fan of the Far Side. I've got actually the Far Side books are behind me someplace. I've got the complete set. That's kind of where my humor is. But the first thing I pictured was one of Gary Larson's cartoons where he had somebody on the rack, right? It was a torture chamber and somebody's on the rack. But I just picture that rack. Going broke slowly just sounds painful, slowly turning that dial.
Yeah. And it's slow, right? You don't really realize it day 1, 2 years, 1 year, 5 years. You really don't realize that, you're not keeping pace. So, I mean, that is really a great analogy because you are just getting the screws turned to you slowly. There's another tongue twister.
Yeah, well,
screws turned to you slowly.
And financially, you're stretched beyond your means. Okay, I'm going to stop with that analogy because I mean, really, it works, but still, I don't know if we want to beat that to death.
Yeah.
So other investments are a better idea, right? I mean, there's so many different investments out there.
Yeah.
What are you saying? I mean, it's got to be other options, obviously.
Right. So let's think about that real rate of return thing again, right? So we know our bank accounts, and we know that fixed rates, bank account rates, most bond rates, et cetera, are at a historic low.
Mm-hmm.
So again, if we're making 1%, the cost of goods and services are going up at 3%, we're losing ground at a rate of 2%, right? Things are going up 2% faster than my account's going up. On the other hand, stocks go up on average over a long term, somewhere around 10%. Now, before the legal folks get too excited about that, every index and every kind of stock acts a little differently over different time frames. But that's a sort of a reference point. So now if we're going up at a rate of 10%, but our cost of goods and services are going up at 3%, we're really making 7% more than the inflation rate. And that's the real rate of return.
Mm-hmm.
Bonds, on the other hand, long bonds are probably 4 to 6%, let's say, in growth rate, keeping pace with inflation or a little better. So I think there are better strategies. Now, that's not to say that being all stocks or all bonds is the right way to go. People, there are 3 things that dictate how much risk a person should take, in my view. Number one, how long the money will be invested. The longer we have to invest the money, the more statistically likely it is we have a profitable rate of return and we're not hurt by those short terms. If you give me the money today and in a year you say I need money back for, to buy a house, there's some likelihood that we're going to be have less value than the money you gave me. We'll lose money over that short term. That's much less likely over 10 years, right? So the longer I have the money, the more risk is supported. The second thing is how well you sleep at night, right? Or how much risk you can really tolerate. My litmus test for taking too much risk with a client portfolio is when the market turns down, and it will.
Mm-hmm.
If you call me and say, I can't stand it, I want to take my money out. Because what happens is we've made this money over time, market goes down, you take your money out down here, we put it in a money market account. People like to call me when the market's gone back up because they say, boy, it looks much better. They want to put their money back in just in time to get shellacked again.
Yeah. Yeah.
Human nature's an interesting thing.
Yeah. Well, we've spoken about that before also. It's the emotions, right? You get scared or you're fearful. I mean, there's, and I know that we'll probably dive into some more of the emotional side of investing in behavioral finance in a future podcast. I know that that's something that you and I've talked about off air before. And I'd love to see somebody come in and have a great conversation with you because I need to learn more about that. Yeah. I make emotional decisions all the time. All the time.
We all do. Yeah. I mean, it's hard not to. Investing is maybe one of the most counterintuitive things you've ever done, right? So the idea of buy low, sell high. Mm-hmm. Well, we've all heard that phrase, but it means, buy a winner. Well, that makes, buy a loser, right? Who buys losers? It's like going to the horse track and betting on the horse that just lost the last 6 races. Who does that? Yeah. Where else in your life do you do it, right? Or sell winners. I'm not going to bet on the horse that just won the last 6 races. I'm going to bet on that loser over there. It's the most counterintuitive thing I think people will ever do is investment, sort of that human nature part of investing.
Yeah.
I started to touch on the third thing that's important. So I don't leave that one hanging. Mm-hmm. It's what I think is happening in the economy. So as a financial advisor, we try to make some decisions about, some tactical decisions about how the direction of the economy is going. Just so we know, my crystal ball is broken. It's, it's not very accurate. So number 1 and number 2 are much more important than number 3.
Yeah, I appreciate the fact that you can admit that you and I are both cracked in this instance when it comes to a crystal ball and maybe just a little touched upstairs here. So when you are looking at your practice, when you're looking at the folks that are coming in, right, seeking your help when they are just first investigating you or people that you're just having a conversation with, right? Around the grill with the margarine in your hand, are you seeing people that are taking too little risk? Are you seeing people that are taking way too much risk? I mean, is it just a variety or is there kind of a trend right now?
No, I see all of it. Well, I'll stay in public sector, right? We talked about the idea that teachers and firefighters, they all have a pension.
Yeah.
That pension is not directly subject to market risk, right? If you stay the course and assuming the same thing doesn't go bankrupt, you put your money in and you get a pension income in return when you retire. Same with Social Security. So you're not bearing the direct market risk of those accounts. So I would argue in many cases, we see teachers particularly, who are very conservative in nature, taking too little risk, right? So they'll put money in and they'll just put it in something very conservative. But if you really thought about it in the context of the fact that you have two other buckets of money or income sources, state retirement and Social Security, you might think about that differently. You might take a little more risk if you really considered your overall financial picture. So that's where I see people taking too little risk. I see a lot of, and this particularly happens in the university system, where University of Arizona, ASU, and Northern Arizona University, we work in those institutions quite a lot. Mm-hmm. People are often in the optional retirement plan. And if you're in that plan, you'll know what that is. But, they picked an investment when they started. 20 years later, they've never touched it again. So it's just sitting there cooking. And they really don't have any context for the amount of risk they're taking or no comprehensive investment strategy that will help them.
Yeah.
So I see it in both.
In the careers where I've had 401ks and things like that, you set it up and it's like the old Ron Popeil commercial, right? Way to go, Ron, by the way. Set it and forget it, right? You just set it up and you don't talk to anybody else about it again, because number one, the person who helped you set up the 401k, they don't reach out to you. I'm sorry.
Right.
Whether they're, managing a huge plan and so they're not speaking with individuals, but nobody really guides you in that process and says, hey, you may want to take a look at how you're, what you've chosen, after 2 years or 3 years or 5 years, or at least once in your entire career to make a change. But we just don't think about that because it is set it and forget it. So you spoke about taking too little risk, right? But where do you see a teacher, a firefighter, a public servant, where do you see them taking too much risk?
So that's the university employee we talked about a lot of times. Sometimes they'll pick an aggressive fund when they start, which makes sense because they have no money invested. If they lose 10% of nothing, it's still nothing, right? So it doesn't really matter. Yeah. But then it grows, right? So most of us aren't Rockefellers. We didn't get, we don't have billions of dollars the day one. So we start with this little bit and we grow it. And if you're in a 401k type investment or the optional retirement plan through the university system, for example, that money can get significant. So now, when you first started, a 10% fluctuation in your market value when you got $5,000 in your account is not that big a deal, right? But you put $500,000 in an investment account and get a 10% fluctuation, starts making your heart beat a little faster. Yeah. And so I think just being aware of that, having a financial advisor who can walk you through that so you understand those things before they happen. I'll say this, my clients can really, I hope, never tell me they're surprised when the market goes down or by how much, because we've met with them often. One of the things we talk about ad nauseum, they're probably tired of hearing me talk about it, is what that risk really looks like. You are going to lose money from time to time if you're invested in the market, and you have to be okay with that. Yeah. And it makes sense for most people, but I don't know. Did I answer your question in that little diatribe? Yeah. I hope I did. Okay.
Yeah. I mean, obviously there's other factors in there. I'm hoping that people listening to this, if they have extra income that, are a little extra money that they want to do some things within the market or, whatever, that it is extra money that you can absolutely lose, right? I mean, I wouldn't mind having an account. I've done this before where I have a couple $100 and I do something outside of the norm with it just because I want to try something out, but it's money I know I can lose, and I usually do. So it is what it is, but I'm hoping that they're not risking anything that they need for their future. And I know that that's where your heart is at, and that's what you talk to your clients about.
So let's talk about that for a second, right? It's important, I think, that you have a good safety net, right? You need some savings money so that when transmission goes out and the hot water heater blows out and Johnny needs dip braces, you can cover those things, because we don't want you to have to take your money out of an investment account. And for retirement accounts, there's specific IRS rules about when you can take them and how that affects you. But we don't want you to have to come to your investment accounts to try to take it, because what if we're down in value when you want that money, right? That's the risk there. So, and one other thing you touched on, and this is my own sort of analogy, but there's a difference between volatility and risk. So we're all going to have volatility. If you're going to invest in the market, stocks, bonds, mutual funds, whatever that looks like, we're going to have some wins and losses from time to time. Really, risk in my mind is that I don't have the money when I want to pull it out. Now, that risk exists, right? We could get hit by a meteor, or we could have a massive pandemic that sweeps the world, or, but so that risk exists. But what I really think is easier or more practical to manage is the volatility, those fluctuations that are going to occur naturally.
Yeah. So, and I know you touched on savings just a minute ago, and I know that you're all about making sure that you have an emergency fund or you have money set aside, like you said, for those things that come up. So that's a given. So we have something in savings, but CDs and money market type accounts, are you saying that people shouldn't have money in that or should? I mean, I know that we're talking about risk, and so I know that plays a factor, but I think they're making so little money right now, right?
Right. So I wouldn't say that you shouldn't have money in them. So for every client, we sort of look at their lifestyle. We try to figure out how much money they should have in liquid assets. So, they'll have some in a day-to-day checking account. They might have some in a savings. Then they might put a little more in a CD. So it's a good way to help to manage that safe money base that you have that, will help with those crises. And then as part of your longer term investment portfolio, and this is, again, what we'll talk about with this asset allocation piece, we talk about some of that money should be pretty safe. Some can be a little more aggressive. And we sort of think about it like a pyramid, right? We have more safe money here. We have a little less.
Yeah.
But the overall structure would be, a way that you could live with the volatility that exists, the ups and downs that we're going to see in the market. That's the goal of building that model.
Yeah. All right. So, I mean, I don't like risk. This is just me personally. I know that listeners are going to be thinking about what risk tolerance they would have and so on and so forth. I don't want to lose money.
Yeah.
I don't want to lose money even if the market takes a big hit to the overall value of it. I know that maybe kind of takes me out of the running for maybe those big wins that people experience, but I don't want that market risk.
Well, Warren Buffett said rule number 1 is don't lose money. Rule number 2 is see rule number 1. So, I get it.
Warren.
Most people want what you want. So it's really, the trick is so that's the factor number 2 I talked about, how well you sleep at night.
Mm-hmm.
Because I say my job is to make you as much money as I can without taking more risk than you can tolerate.
Yeah.
So I need to try hard to gauge what that amount of risk is for you and make sure you understand it so that when we have some of those fluctuations, which are going to happen, those down markets, that you're okay. You're not losing sleep. You're not watching the ceiling fan go around in circles all night. So that's an important component of really trying to understand that. One more thing along that lines is we'll try to assess that when we first meet and set up an investment portfolio, but we'll fine tune that throughout the course of your investment life, right? That'll change some. Closer to retirement you get, the less risk you're likely to be okay with. The more money you have, the more those swings start to feel worse when you lose money, right? And so we'll try to adjust that and just work to make sure you clearly understand how much risk you're taking in any portfolio so that you're comfortable with it and really understand it.
Yeah. Again, I'm hearing a theme here, right? I'm kind of cluing in on the fact that you're really saying it's the long term. It's I don't want to call it the long game versus the short game, but for terms, that's kind of what sticks in my brain. You're saying long term is what you've got to be prepared for.
Yeah, I think that we should prepare for all kinds of terms of need, right? So that's why we have money in savings, because that's a short-term need. If Johnny needs braces and the car transmission goes out, I need to have a bucket of money that I can go to. And having that money in a position of volatility or risk is probably not that appropriate. But if you're 30 years old and you've got 30 years till you retire, we can probably take more risk with that money than we took with the savings or the safe money.
Mm-hmm.
I'll tell you one more place people fall down, and that's retirees, right? So let's say you retire at 60. Well, the average life expectancy, I'm not looking at it, but let's say it's got to be pushing 85 now, right?
Mm-hmm.
I've got to make that money last for 25 years. So I can't just pull my head in and make 1%. Because again, if the stuff I want to buy is going up at 3%, and I'm only making 1% for 20 years.
Yeah.
We're going broke slowly.
Mm-hmm.
So it's really an ongoing process, I feel like. And it's something that it's probably the biggest thing that I do is help people understand the amount of risk they take in a portfolio and make sure that they're okay with it.
Yeah. And we have a diverse audience. Let's put it that way.
Yeah.
A wide audience. This podcast is nationwide. So there's people listening to this from all walks of life.
Sure.
And I guarantee there's somebody out there thinking, look, here's what risk is. It's either all or nothing. If you don't risk it, you're not going to win. There's hard drivers out there that are like, I'm putting everything on black 30 or whatever the numbers. I don't know what the numbers are, but they are like, I'm risking it all because I want that big win.
Yeah.
What would you say to that?
Well, I would say we're Irish, so we're redheaded. So we say, put it all on red. No, I'm kidding.
Please don't take that advice. That's not advice.
Just kidding. Just kidding.
Yeah.
Yeah. I think if that's what you think, here's what I tell people to do. Go out and open a self-directed account somewhere. Go out and open an online account and give that a shot.
Mm-hmm.
Because, we all win some and we all lose some. We all tend to remember our wins and not our losses,
mm-hmm.
right? And it's just a much harder process than you think. If you think about investing in Apple when they were a garage company, right? Well, the risk you took there, I mean, the vast majority of companies that start in somebody's garage are not here today.
Correct.
So the fact that you got that one right is if you did it way back when, is a miracle. So that idea that you can catch that is almost like catching lightning in a bottle.
Yeah. And the problem is that hindsight's 2020. We talked about that.
Right.
And we all see the people that won in that scenario, right? Yeah. What we don't hear, and because you didn't name any of the garage startups that failed because you don't know them. You don't know them because you don't hear about them, right?
Right.
So we heard about, and here's the bad thing is I grew up in the Seattle area. So
yeah,
I constantly in my probably mid 20s, early 30s, remember thinking, man, if I had just taken my paper route money and bought Microsoft, invested $1,000 because as a kid, I had $1,000 for my paper route after a few months. Right. Made way too much money on that paper route. But if I had invested that in Microsoft, I would have blah, blah, blah today. Well, guess what?
But of the thousands of companies you could have picked, would you have picked Microsoft?
Probably. I didn't even know Microsoft when I had the paper route.
Right. It's not like saying I'm going to go invest in Joe's technology company that's in his backyard. You know, I mean,
exactly.
Might make it, but
can you imagine, seriously, you're looking at this company in the garage. You named this thing Apple? Fruit?
It's what?
And you think this is gonna take off? Really? Why don't you name a banana? I mean,
And by the way, Steve Jobs, you seem a little cuckoo to me when I look at you, but obviously you're a brilliant man. But exactly. I don't know. Right?
Sometimes we just don't recognize genius.
And that's right. That's right.
Man. Yeah. All right. I know that we're going to be talking more about investing and not panicking in another session, right?
We are.
Okay.
So really we want to do 3 or 4 sessions here. This one is really designed to be about why taking some risk might make some sense and what the framework for that is, understanding that the real rate of return is what's really important. So you've heard people say it's not how much you make, it's how much you keep, how much you make above and beyond the cost of goods and services and the way they inflate. We'll talk about how to diversify money. So we touched on it, the idea that it's not all Bitcoin or, money in a tin can. There's this whole continuum. We'll talk about that in the next session. We'll talk about staying the course. So once you pick a strategy, why it's important to just sort of stay with it. We'll probably also do a session on trying to tune the noise out because the media, will always tell me about,
absolutely.
Media's Chicken Little. They don't send media crews to watch planes land safely, right? They only tell you about the plane that crashed. So,
it's a great
easy
analogy.
to think that my office, we call them Jimmyisms, but whatever.
Can you imagine that reporter? Well, we had another safe landing, everybody.
Yep. Another 747 touchdown. We're good.
Oh, look, it's a 737 this time. Nice landing. Way to go.
Yep.
Sorry.
Yep.
I'm just picturing Elf, the movie Elf, when he runs into the coffee shop. You guys made the best coffee in the world. Way to go. Sorry.
Yeah, that's top notch.
Yeah, it's good stuff.
Hey, that's why this is fun with you, man. We have fun doing this stuff.
Yeah, absolutely. All right. But before we get to those other sessions, give the audience a sneak peek on how you help people figure out what their risk tolerance is. How do you help somebody decide how much risk they want to take so that they can prepare themselves for these next few sessions to kind of gauge themselves, and hopefully, they're going to reach out to you. We're going to give some contact information and some resources here at the end of this podcast.
Sure. But so when you reach out, we have a risk tolerance questionnaire, sort of a standard questionnaire that says, what do you do if the market goes down 10%? What's your reaction? How do you stomach that? And then we just have some intuitive conversation around that. And we might look at a proposed portfolio to see how it's fluctuated up or down over time. The real magic in that, though, I believe, is ongoing communication. And so once we get a portfolio built, then we have some tools that help us look at that portfolio and say, how much risk is it taking? What's a bad scenario look like? And how much dollars is that, right? Because it's my business. We like to say, well, you have a 10%, possibility of a 10% correction. Well, what is that in dollars? Again, if you got $5,000 invested, 10% may not be a big deal. If you got $500,000 invested, 10% might keep you up awake at night. Yeah. And so we try to help you understand that going forward. So it's an ongoing process. We have a lot of tools for that. And so hopefully we're good at it.
Yeah, absolutely. All right. We're wrapping this podcast up. What is the one takeaway from today?
I guess think really hard about risk. Understand that it's probably a good idea to have it. Think about that real rate of return. And if you have a chance, reach out to a financial advisor who can help you understand that and build a strategy to stay ahead of that real rate of return. Create a positive real rate of return.
Yeah, absolutely. All right, Jim, I know that you have some resources on your website that you are more than willing to give to people for free or through email if they want to reach out. How do they get those resources? Where do they find them, or how do they get them from you?
So you just go to our website, www.diversification, sji.us.com. At the bottom, there's an investment quiz, which is kind of telling, help you kind of understand where you are and, how much maybe you know. And then there's also a white paper you can download on investment basics. So those are both good tools. And of course, you can always reach out to us. You can find us through the website. You can call us at our phone number, 520-326-6133. Email. We're pretty easy to find if you start looking.
All right. Jim, always a pleasure, sir. Thank you so much for your time today.
You bet, Eric. My pleasure. Thanks for your time, buddy.
You bet. And our last thank you, of course, goes to you, the listening audience. Thank you so much for tuning in and listening to The Money Study with Jim Bishop. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Jim comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. And this is a great series to share with them because then you can actually start to discuss it and talk about your risk versus their risk, what their thoughts are. And you guys can all get the resources from Jim and his team and just get smarter. That's what we're hoping this podcast helps everybody get a little bit smarter about their money. And I think that's very important. I know that Jim drives that point home with all the education he does. Again, thank you so much for listening today. For everyone at SJI Financial Services Incorporated, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Money Study Podcast. Click the subscribe button below to be notified when new episodes become available. The opinions expressed in this podcast are those of the speaker and/or the guest and may not necessarily reflect those held by Voya Financial Advisors. Comments concerning the past performance of monetary instruments, investment indexes, or international markets are not intended to be forward-looking and should not be viewed as an indication of future results. Investment advisor representative and registered representative of, and securities and investment advisory services offered through Voya Financial Advisors, Inc., member SIPC. SJI Financial is not a subsidiary of, nor controlled by Voya Financial Advisors.
Using diversification asset allocation as part of your investment strategy neither assures nor guarantees better performance and cannot protect against loss in declining markets. Investments are not guaranteed and are subject to investment risk, including the possible loss of principal. The investment return and principal value of the security will fluctuate so that when redeemed may be worth more or less than the original investment. Generally, the greater an investment's possible reward over time, the greater its level of price volatility or risk.